How do you know if your savings are enough? Most people won't know if they planned retirement correctly until it's too late. They'll spend 30 years saving, maxing out accounts, follow the advice, and still arrive at 60 asking, is this enough? That's the flaw in traditional retirement planning. It tells you how to save, but not what you're actually building toward. Today, we're talking about why reverse engineering your retirement is the smartest way to plan for financial freedom, and why it gives you clarity decades before most people ever get it. The standard advice sounds responsible. Max your 401k, invest in index funds, retire at 65. This model grew alongside firms like Vanguard Group, which championed low-cost index investing. And to be clear, long-term diversified investing works. But here's the issue. It's built on averages, average returns, average retirement age, average lifestyle costs. Your life is not average. What if you want flexibility at 55? What if you plan to travel extensively? What if healthcare costs rise? What if you don't want to stop working, just scale back? Traditional planning starts with contributions. Reverse engineering starts with clarity, and clarity changes outcomes. Reverse engineering retirement flips the sequence. Life first, income second, capital third, strategy last. Instead of asking, how much should I save? You ask, how much income will my life actually require? Let's say you determine you need $75,000 per year in retirement. Now we have something concrete. According to research associated by Trinity University, 4% divided by your goal should ultimately give you the final number to save for. In this case, that income implies roughly to $1.875 million. Now, retirement isn't vague, it's measurable, and measurable goals change behavior. Here's where this method becomes powerful. If you're 35 with $100,000 invested and you want to reach $1 million by 55, the math will quickly tell you whether your current savings rate supports that goal. If it doesn't, you can adjust now, and not at 60, not when options are limited, not after a market downturn exposes the gap. Once you have an idea, you can increase your income, reduce the lifestyle target, extend the timeline, or build alternative income streams. Reverse engineering reveals reality early, and early clarity is a competitive advantage that most people never have. Traditional retirement planning often relies on one engine, your investment account. Reverse engineering expands the system. If your target is $75,000 per year, that income doesn't have to come entirely from a stock portfolio. It could include dividend income, rental property cash flow, REIT distributions, consulting income, digital products. Let's say you build a rental property that generates $20,000 per year net. Now, your portfolio only needs to generate $55,000. $55,000 divided by 4% equals $1.375 million. One asset reduced your capital requirement by $500,000. Layered income reduces pressure. Reduced pressure increases flexibility, and flexibility is the real definition of retirement. Markets don't move in straight lines. We've seen inflation spikes, bear markets, recessions, policy shifts, even though long-term investing remains powerful, especially through diversified index strategies. Reverse engineering acknowledges volatility. You stress test assumptions. You plan conservatively. You build margin. Instead of assuming everything works perfectly, you design for imperfection. That difference matters most when markets decline 20% because systems survive what optimism cannot. Most retirement anxiety comes from vagueness. Am I saving enough? Am I behind? What if this isn't enough? Reverse engineering replaces vague fear with measurable progress. If your goal is $1.8 million and you're at $900,000, you're halfway there. Progress becomes visible. Momentum becomes motivating, and when markets fall, You revisit the system. You don't panic. Design beats emotion. There are two types of investors planning retirement: those who hope it works and those who design it. Reverse engineering starts with life, not age. It defines income before capital. It reveals trade-offs early. It builds layered income. It prepares for volatility. It reduces emotional uncertainty. Most people drift toward retirement. Smart investors architect it. And when you architect your financial life deliberately, you don't just prepare for retirement. You prepare for freedom. Structured, intentional, sustainable. If this helped clarify your strategy, subscribe for more frameworks that turn uncertainty into ownership. And remember, ownership creates optionality. I'll see you in the next one. Thanks for watching. This is The Solo Investor.